Ever wondered if gold and silver are truly interchangeable during inflationary times? Many assume these precious metals behave identically, but this couldn't be further from the truth. Understanding their distinct characteristics is crucial for investors, economists, and anyone seeking to safeguard their financial future. Gold and silver have captivated humanity for millennia, serving as symbols of wealth and mediums of exchange. Their shared history often leads to them being grouped together in financial discussions. However, their responses to economic pressures, especially inflation, reveals significant differences. This analysis aims to provide a balanced perspective, highlighting key distinctions for informed investment analysis and portfolio diversification. We'll explore how each metal functions, offering valuable economic education for students and the general public alike. For centuries, both gold and silver underpinned global monetary systems. Their intrinsic value and scarcity made them ideal for commerce. Yet, their specific roles within these systems were often quite distinct. Gold typically served as the bedrock of national reserves and facilitated large-scale international trade. Its high value-to-weight ratio made it suitable for significant transactions and wealth storage. This established gold as a primary monetary asset. Silver, while also monetary, was the metal of everyday transactions. It was the currency for daily commerce, wages, and smaller purchases. This practical application gave silver a different kind of economic exposure compared to gold. One of the most critical differentiators for silver is its dual identity. Unlike gold, which is predominantly a monetary asset and store of value, silver also boasts extensive industrial applications. This dual role profoundly impacts its price dynamics. Silver is an essential component in electronics, solar panels, medical devices, and various industrial processes. This means its demand is heavily influenced by global economic growth and technological advancements. Industrial demand can account for over 50% of annual silver consumption. Gold, by contrast, sees its demand primarily driven by investment, jewelry, and central bank reserves. While it has some industrial uses, they are minor compared to its monetary and aesthetic roles. This makes gold's price less susceptible to industrial cycles. Due to its significant industrial component, silver typically exhibits higher price volatility than gold. This characteristic is vital for investors to consider when constructing a diversified portfolio. Silver's price can swing more dramatically in response to economic news. During periods of robust economic expansion, strong industrial demand can propel silver prices upward, often at a faster rate than gold. Conversely, during economic downturns or recessions, reduced industrial activity can cause silver prices to fall more sharply. This heightened sensitivity makes silver a more speculative asset for some. Gold, often seen as a safe haven asset, tends to move more steadily. Its primary drivers are monetary policy, inflation expectations, and geopolitical uncertainty. This relative stability makes gold a preferred choice for wealth preservation during turbulent times. Examining historical inflationary periods reveals varied performances for both metals. Silver's behavior often depended on the broader economic context accompanying the inflation. For instance, inflation coupled with strong industrial growth could see silver outperform. However, if inflation was driven by supply shocks or monetary expansion without corresponding industrial demand, silver's performance might lag. Gold, in such scenarios, often maintained its role as a hedge against currency debasement. These historical patterns offer insights, but are not guarantees of future performance. Understanding these nuances is crucial for financial analysts and investors. It highlights that inflation hedge is not a monolithic concept, and different assets respond uniquely to various inflationary pressures. Strategic asset allocation requires this detailed understanding. The supply side of gold and silver also presents distinct characteristics. A significant portion of the world's silver supply is produced as a byproduct of mining other metals, such as copper, lead, and zinc. This means silver production is often tied to the economics of these base metals. If base metal prices are low, mines might reduce output, inadvertently impacting silver supply regardless of silver's own demand. This structural dependency can lead to supply inelasticity for silver. Gold mining, conversely, is more directly driven by the economics of gold itself. This difference in supply dynamics affects how each metal responds to market forces, including inflationary pressures. A sudden surge in silver demand might not be met with an immediate increase in supply, potentially leading to sharper price movements. Historically, silver maintained purchasing power over long periods, but often with greater variability than gold. Its role as everyday money meant its value was more sensitive to local economic conditions, trade balances, and government policies regarding coinage. This made it more susceptible to debasement or revaluation. Gold, as a reserve asset and the ultimate store of value, generally exhibited a more stable long-term identity. Its role in international settlements and as a central bank asset gave it a different kind of resilience. Both metals preserved wealth, but through different mechanisms and with varying degrees of short-term fluctuation. For financial planning, recognizing these historical roles helps in understanding the long-term risk and return profiles of each metal. It underscores why gold is often considered a foundational asset for wealth preservation, while silver offers more growth potential but with higher risk. The common pairing of gold and silver in financial discourse stems from their shared monetary heritage and status as precious metals. They are both tangible assets, offering an alternative to fiat currencies. However, assuming identical behavior can lead to suboptimal investment decisions and misunderstandings. Each metal reflects different facets of economic and monetary change. Gold often signals concerns about currency stability and systemic risk. Silver, with its industrial ties, can signal broader economic health and technological progress. A comprehensive investment analysis requires distinguishing these signals. For students and the general public, appreciating these differences is a vital part of economic education. It moves beyond simplistic notions of precious metals to a more nuanced understanding of market dynamics and asset classes. Ultimately, silver is not a mere substitute for gold, nor is gold a substitute for silver. They serve distinct, often complementary, functions within an investment portfolio. Understanding these distinctions is paramount for effective portfolio diversification and risk management. Gold can act as a defensive asset, providing stability during economic uncertainty and protecting against inflation. Silver, while also offering some inflation protection, can provide higher growth potential during periods of industrial expansion. Its volatility can be harnessed by investors with a higher risk tolerance. A well-structured financial plan might include both, leveraging gold for stability and silver for growth potential. This balanced approach avoids oversimplification and maximizes the benefits of each metal's unique characteristics. During inflationary periods, gold often reflects changes in the purchasing power of currency and acts as a hedge against monetary debasement. Its value tends to rise as confidence in fiat money erodes. This makes it a direct play on monetary inflation. Silver, on the other hand, reflects a combination of monetary conditions and real economic activity. Its price during inflation will depend not only on the devaluation of currency, but also on the strength of industrial demand. If inflation is accompanied by a recession, silver's industrial demand might suffer, tempering its rise. Recognizing this dual influence allows for more informed and calm discussions about precious metals as inflation hedges. Gold and silver, while sharing a rich history, exhibit distinct behaviors during inflationary periods. Gold primarily reflects monetary conditions and acts as a traditional hedge against currency devaluation. Silver, with its significant industrial demand, reflects both monetary changes and the health of the global economy. Understanding these fundamental differences is crucial for investors, economists, and anyone engaged in financial planning. It enables a clearer, more analytical view of precious metals, moving beyond assumptions to informed decision-making. This nuanced perspective is key to strategic asset allocation and building resilient portfolios. This content is for educational purposes only and is not financial or investment advice. Always consult with a qualified financial professional before making any investment decisions. If this detailed analysis has helped you better understand the complex world of precious metals, please like this video and subscribe to our channel for more insightful content. Your engagement inspires us to continue providing valuable economic education and investment analysis. Share your thoughts in the comments below. We love hearing from you.